Hey friends, have you ever wondered how you can pay off your mortgage faster? Or maybe you like to help your kids get into the real estate market. Or better yet, retire with some passive income. Well, you're in the right place. Welcome to the Sylvia Ho Mortgage Podcast. My name is Sylvia. I'm here to teach you how to achieve your goals simply by owning just one more property. Hey everyone, it's Sylvia here. Welcome to the J.O.M.P podcast. Today we have two visitors. We have Ben and we have Derrick. Ben and Derrick are insurance agents and a family law lawyer, and they talk about how to protect our wealth. The J.O.M.P program is all about owning just one more property and building wealth, and real estate is a way to increase your net worth. So we want to know how to protect that now.
Most of my clients are wanting to learn how to build wealth outside their 9-to-5 through the J.O.M.P strategy. And the J.O.M.P strategy is all about owning just one more property and building wealth and building intergenerational wealth to pass down to our kids and to our grandkids. Now, the J.O.M.P method is all about offense. It's all about building that wealth. Today, we're going to be talking about defense. We're going to talk about how to take care of those assets that we built up over time. And we have Ben Corriveau. He's a financial planner and an insurance agent. He's from Founders Wealth. And we have Derrick Ang, who is a family law lawyer. Welcome, Ben, and welcome, Derrick.
Thank you, Sylvia. Nice to be here.
Hi, Sylvia. Thank you for the introduction.
You're welcome. Nice to have you guys here today. So I teach my clients how to buy one more property because, in my opinion, real estate is a way to increase your net worth by a lot, right? But there's something called government and tax, right? And someone shared with me, they're like, Sylvia, you know what? You've bought all these properties. You have all this wealth. What are you going to do when you die? Like, have you taken care of your death tax? I'm like, what? What is death tax? What are you talking about? Like, I have to pay taxes upon my death. And then, so that's where we got into the whole idea of life insurance. So Ben, talk to me about how my clients can protect their assets with life insurance.
So one thing I keep in mind, especially when working with real estate investors, is knowing that what they're doing is really, it's trying to supercharge their portfolio. They're not like the average investor, where they're willing to look at the bigger picture and really control hard assets, which is great. It's fantastic, but we got to really make sure we look at the full picture on what that asset's eventually going to be and what the purpose is. There's two spots to it. So it's growing an asset and then using that as income in retirement. So when I like to start with a plan is try to mitigate the risk for the short term. One thing that is necessary for a real estate investor is to keep making sure these mortgage payments are maintained. And a key to that is that, hey, we're here to do it. We're here to make these payments. So if husband and wife own a property, they might be relying on two incomes. So if there's all of a sudden in the short term, one income that's not there, that's going to be big trouble for the long-term picture that they have together. So really easy thing to put in place is a simple term life insurance policy that'll be there to protect in the short term, to make sure that whether one spouse is there or not, the entire family is still going to benefit from that plan that they started on.
Okay.
And the second is to think about really the inevitability of passing on those assets. So when you pass on those assets, the government is heavily involved. One thing that's true when it comes to money, you can spend it or you can give it away. If you're going to give it away, please don't give it to the government. So when we pass over an asset, there's going to be a tax bill that's in there. So working with Derrick as well, we create an overall strategy. What's going to happen with that asset? Who is it going to be given to? So whenever it's given to somebody, there's likely going to be a big tax bill that's at that point. And working with real estate investors as well, their mindset's like a business. They might not consider themselves business owners, but really they're operating like a business. So when a business has to pay a certain bill, they don't want to use working capital. Working capital is really that hard-earned money that's tied up in the real estate. So you have two options. You can sell a piece of real estate. You might have the liquidity that's in there in your accounts, probably not. Or there's a life insurance policy that's there at the end to really take care of that tax bill that's going to be presented to the family. So it's an immediate injection of money that can be used to pay the tax bill to make sure that the family really maintains control over the real estate assets.
Let me recap and please tell me if I'm saying this correctly. So let's just say I have a property, I die, my husband dies, and we pass that property to my kids. My kids will have to pay taxes to the government because we're passing wealth down. Is that what it is?
In all likely scenarios, that asset's going to have some growth on it. So any of that growth that was created in there, there's a tax bill that's owing at the end of it. So it really depends on the type of asset, depends how it's structured, depends on how much growth is there. We don't know how much it's going to be at the end, but we can plan pretty closely to what's going to be expected there. And then instead of having to sell the asset to pay the government what's owed, you're really just going to use insurance money to pay that tax bill and then really hang on to that property for the kids.
Okay. Yeah, I definitely don't want my kids selling the properties. It's already so hard to get into the Toronto real estate market right now. In the future, even more, right? First-time home buyers are being priced out of the market. So I don't want my kids to sell it, but they have this tax bill to pay. So how do we pay that tax bill? We pay that tax bill via the long-term life insurance that you're talking about.
Exactly. And when you say that too, you don't want the kids to sell the property. And also you don't want to be them forced to sell it on a certain date, right? So can't time the market, but you don't want to be in this position where you're in a down market and you're forced to sell it regardless of what your future aspirations are. So you really want to make sure they still have control over the plan that you created.
All right. Okay. Yeah, that's a really, really good point. So what you're trying to say is that if there's a downturn in the market and upon my death, they can't pay, and if I didn't have life insurance and they can't pay that bill, they're going to be forced to pay that bill. They're going to be forced to pay it on a downturn, but then they still have this big bill to pay.
So the not so technical term is a fire sale, right? So we know we have to sell on that certain day.
Oh, that's absolutely horrible. Now, I'm assuming that there's been cases where if the bill is too high and the sale doesn't cover it, then what do they do?
There's always going to be a way. So the tax bill that's on there is tied to the value of the real estate. So the real estate's always going to be able to take care of the tax bill.
It's just whether there's anything left over afterwards, right?
They're still likely going to be able to take care of it. But like we said, we did all this hard work for so many years. We don't want to see it crumble at the end. We just want to have these defensive strategies that are in place that aren't going to break the budget, really. So life insurance is never going to be designed to restrict you on making any future purchases that you want to have. It's just there to be a complement to all, including defensive strategy that's in place with somebody like myself, someone like Derrick, that can really just make sure that you have a clear understanding of what's in the whole picture of owning real estate.
Okay. Because I know the wealthy, they do three things. They leverage, they make sure they have prenups, and what's the other one? Cohabitation agreements. And they definitely have wills in place, right? So those three things, and they have life insurance, right? Those are the three things that wealthy people all the time.
People sometimes, when they think so real estate investors, if you have a plan of Sylvia, you're going to be a wealthy individual. You're going to grow your net worth. You're going to be considered a high net worth individual. And a lot of people think when they're in that scenario, well, I'm high net worth. What the heck do I need life insurance for? But really, it might not be a need, let's say. So you might not need it to have your kids be able to get dinner, but you certainly will likely want it because it's a complementary piece that isn't going to break the budget, but it's going to add liquidity. It's going to add, basically keep building the overall plan that you have. So like I said, don't overlook it by thinking, okay, you don't necessarily need it, but 99% of the time you're going to want it.
So now that you talked about budget, like, is life insurance expensive?
No, it depends on what type of policy that you want, but it should never be expensive in terms of the overall budget. So it should never really break any long-term planning goals that you have. It's just a needed piece in there to make sure that if things don't go as absolutely planned, your family's taken care of. So it becomes more expensive as we get older. So a good thing to do is get it young and get it when we're healthy, because as we age, prices will go up. And the likelihood of our health going astray could happen as well. So underwriting is not as difficult as it used to be. For example, diabetes used to be uninsurable. But now with the progression of medicine, doctors are able to basically insure a long livelihood for people. So insurance companies are there to basically say, okay, we see the future. We're able to confidently insure somebody. But keeping that in mind, the younger we are, the healthier we are, it's easier to get, the cheaper it is.
Got it. So what you're saying is that even if I've been declined in the past, to still come and talk to you because life insurance policies have changed where you have diabetes, you have an insurance company that would still insure that individual. Like it's not an automatic no anymore. Is that what you're saying?
Definitely. Yeah. So don't be discouraged if you ever had a difficult process getting life insurance in the past. Like we said, so one big reason that things do change, life insurance companies are willing to underwrite things that may not have been in the past, but also working with independent advisors that are able to really shop the full market and see if there is an option out there. And the more experience that you have in this business, the more you're able to communicate with underwriters and properly tell the story of an individual instead of just leaving it as one piece of paper with something that might look scary on the surface. But really, the more you dive into it, the more you can make sense of the case to an underwriter and provide insurability to the client.
Okay, got it. So as a mortgage agent, by law, I must offer mortgage life protection. Okay, so my clients must either apply for it or waive it. The two answers that I always get is, oh, Sylvia, I already have life insurance through work. I don't need the life insurance through you. How would you address that?
Well, I'd address it by making sure the client truly understands on the type of policy that they have, because life insurance isn't something that we like to think about too much. Let's be honest. It's not fun to think about dying one day. So it's always kind of brushed off. And once you see the word life insurance, your brain is automatically going to assume that you're covered because you really don't want to think about it too much. So what I'd say to somebody in that scenario is let's sit down and really let's just go over and have a clear understanding of what you currently have. If it's a group policy, that might be limited to your 1 year salary, your 2 year salary. So it's not going to be as much as you probably need. Also, if we're on the topic of a group, if you change your employer, you don't really get to take that policy with you. So, Sylvia, when you're offering a client a mortgage, like you said, you're required to offer them some type of life insurance, and really that's in place to protect the consumer because it's so overlooked and so important that regulators got involved and said, you know what, there's too many people that are leaving these massive debts owing when they pass away. So that's why it's required. But there are many, many options. So working with a professional, I like to say, sitting down with an hour, at the very least, you're going to know exactly what you have and be confident when somebody asks you, what type of life insurance do you have? And then you can be able to see what the options are and you're going to make an informed decision together.
How long does it take to get it approved?
Yeah, so it's one thing. Life insurance companies are really progressing on the types of technology that they offer and really making it a much better experience than it used to be for applying for life insurance. So no longer require, for the most part, blood and urine, which is always the biggest pain to get a life insurance policy in place. Nobody wants to have somebody come to their home, take their blood, take their samples. It's just very intrusive. So for the most part, that's no longer required for individuals. For example, so a 50-year-old can get insured for up to $3 million with most major insurance companies in Canada without having to provide the blood and the urine. So with that, it's an application process that takes about 30 minutes. Underwriting, it depends on the individual, but typically it's within 3 to 5 business days. So we're seeing things that used to take 4 weeks to get in place can be done electronically within days, sometimes even within hours. Again, depends on the individual, but it's a much, much quicker process than it used to be.
Oh, that is a much quicker process. So like I said, by law, I have to offer mortgage life protection and it's through Manulife. It's a Manulife mortgage protection. And what I tell my clients is that I don't know anything about life insurance, right? Like I only know about my own life insurance, but I don't know about policies and stuff like that. That's where the professionals like yourself come in, right? But what I tell my clients is, even if you think you have life insurance properly in place, you always have to get reassessed whenever you go into more debt, right? Whenever you get a mortgage, right? So what I tell clients is to apply for the Manulife mortgage insurance. Some coverage is better than no coverage. That's the first thing that I tell my clients. And then the second thing that I tell my clients is that you can get all your money back in 60 days. So if you cancel this Manulife life insurance on day 59, you basically got free coverage and they give you all your money back.
Very, very crucial point there because a lot of people will say no to something so they can shop around. You don't want to leave yourself that vulnerable at any given time. Unfortunate things happen, and you do not want to leave that burden to anybody. So if you're in the scenario of taking on a new mortgage, get the insurance if you don't have anything. Talk to me, talk to a insurance professional, and just make sure you have a clear understanding of what that is. And another point that you made as well, needs change constantly. The highest that it can be is when we have the most amount of mortgages, we have young kids, but we don't know exactly what the future is. That's why having a plan that can change with you, it's flexible, is also key. So it's not just one thing that's done and you're never going to think about it again. I'm going to bug you once a year. I'm going to check in with you to see if anything changed and make sure, again, that you have that clear understanding as well.
Beautiful. Are there different types of plans that help someone with their changing needs? Like, are there different types of plans?
The term policy that I mentioned at the start when we started speaking was it's set for a period of time. So it can be a short period, it can be 5 years, it can be all the way to 65. And then there's also permanent life insurance policies. Permanent life insurance policies, think of it as owning the policy. It's never going away. The term policy is renting the policy. Big difference there. So it's the if versus the when. Eventually we will pass away one day. The permanent is going to be there for when that happens. The term is sort of the if. If something happened to you in this period of time that we have a policy, beneficiaries will be provided with that lump sum tax-free money. And with the flexibility part, a lot of companies have conversion options for these terms. So we can always reassess and convert as needed to take some of that term and turn it into permanent.
Okay. You're saying there's two types of life insurance. There's term and then there's life, whole life, right? And then depending on your budget, depending on your different stage of life and your needs, you could always convert one to another.
Yeah. So we know that when somebody's, let's say, a young real estate investor, the most important thing is that they're making those mortgage payments, whether they're here or not. So it's going to be through life insurance. And then as they age, our concerns are now about what kind of tax bills are we going to be looking at for passing over these properties. So we take those term policies, we convert them to the permanent without having to reapply for new underwriting, basically. So these policies can be converted regardless of health at that time.
Okay, beautiful. Is there anything else that you want to tell our listeners today about life insurance?
Don't be scared of it. I haven't met anybody that was upset they got life insurance later on down the road. I know a lot of people that have policies that they've had for 50 years and nobody's complaining that they had this policy from the past. So it's something, just sit down with a professional and get an understanding of it. A lot of people, it's kind of nags at them. They know they're in the dark to what their actual coverage is. They know they want to have proper coverage, but it's just taking that step to really sit down and review.
Thank you very much, Ben. I really appreciate your insight on all this. To my listeners, life insurance is very, very important. And it's just all about protecting our assets and making sure that we can pay the bills that we can, right? And taking care of our loved ones after we die. Now we're going to go to Derrick, Mr. Derrick. He is a family law lawyer, and he totally opened up my eyes to what a cohabitation agreement is and what was the other one? A prenup, and how the wealthy totally use it and why the middle class don't really think about it. Right. But for those who have purchased that rental investment property, you are wealthy. You are wealthy, my friends, and you need to protect that. And there's two different ways to protect it. So, Derrick, why don't you tell us what are ways to protect it via a prenup and a cohabitation agreement?
Hi, Sylvia. Thank you for the introduction. I totally believe that the middle class is often overlooked when it comes to rental properties and protecting their wealth. And it's a cohabitation agreement and a prenup, or in Ontario, more or less known as a marriage contract, is used by the wealthy class to protect their assets, right? Because you've worked so hard and you're trying to pass down this intergenerational wealth to your children. And then all of a sudden, like Ben covered, you're hit with this estate administration tax, right? So when you pass away, there's this tax that you have to pay the government. So I can't stress it enough that I've worked with some of my clients. And, luckily enough, there was a life insurance policy there to protect your assets. But in this case, we're looking at sometimes, your daughter or your son, they might have a partner, they might be married, they might be living there domestically. And that's when it becomes a problem. When they're common law or they're married, your property might be designated as a matrimonial home, right? And when you own multiple properties, whether it be a cottage or it be a commercial unit, when they share in a joint venture and when they designate that property as a matrimonial home and its intended use, that's when it becomes a bit sticky, right? So I always urge my clients to talk to a family law lawyer, whether it be myself or anybody else, just to get your advice, because I offer a 30-minute consultation, and it's, all of my clients come to me after and they're like, oh my God, Derrick, thank you so much. I wouldn't have known otherwise. Whereas, a year or two down the road, you're going to court and it's costing tens of thousands of dollars. So it's really taking a preventative or proactive approach and spending a couple thousands of dollars to protect all of the wealth you've worked so hard for.
Okay, so let's go through some scenarios, because we went through some scenarios earlier and my mind was like blown away. So let's just say I own a condo. It's under my name and my husband's name, and my kid moves in. That's okay. Okay. And then my kid has a partner and they both move into that place. In my opinion, I'm just like, well, this is my place. They have no access to it. So talk to me. Do they have access to it?
That's where it becomes complicated, because under common law, they have no property rights. They're not entitled to any property. But when they get married, that's when it becomes an issue, right?
Okay.
So if they become married and they're living there full time, that's when, it becomes a bit sticky, because if they break up, they go through a divorce, he is now entitled to half of that condo, even if it's
even though
name.
The condo is under my name.
Yes, that's correct.
That's
it's
crazy.
Again, it's not like 100%, but again, if it's designated as the matrimonial home, he just has to show the court that this is where I live throughout the relationship. And the longer that they live there, right? And then the courts might consider, oh, that's a gift to your daughter or whatever it is. So it's actually, you're holding the legal title. She's actually the equitable title. She's actually the one living there, right? So that's why it's always important to have a marriage agreement or a cohabitation agreement set up. Because even for common law, right, if they use that unit as like a startup for their business, it's a joint venture, there's a commingling of funds, right? Your daughter or your son, they open a joint account with their partner, right? The courts will look at it as, what was their intention? What did they intend to do? And it's more important to set out a contract. This is what's mine. This is what's yours. And that way there's no sticky fingers. There's no messy fights at court.
Okay. So that totally threw me off when you shared that with me. So what do I do to protect that asset? Is it an agreement between myself and my kid that this property does not belong to them? Or is it an agreement between my partner and their boyfriend or girlfriend, depending whether my son or daughter lives in there? Wait, who has this agreement? Is it me and my kid agreement or what?
There's two ways to protect it, right? There could be an agreement between yourself and your daughter, but generally it's better to protect your daughter or your son from their partner. Okay. And this happens a lot when there's intergenerational wealth being passed down, and, they get an e-account with a lot of inheritance from their mom or dad. And, they sell that condo, right? That it was previously in your name. It gets transmitted to them, and then they buy another property with their partner, right? So what happens then is there's an excluded gift, right? That's not shared with their partner, but now all of a sudden they're mixing the money, and that's no longer excluded. And that's where the danger is. So it's very important to set out in a cohabitation agreement or a marriage contract that, hey, like, this is excluded wealth, or this property, I own this amount of the property. And that can be done simply with sitting down with a lawyer, and it might cost you $1,000 or $2,000, and it's going to protect you tens of thousands of dollars in the future.
So it's an agreement between my kid and their spouse.
That's correct. You can do it between yourself and your daughter or your son to make sure that, like, hey, this is, even though you guys are living there, it's to be excluded from the net family property. It's like an estates kind of thing. I think the protection, more or less, that's immediate would be the family law protection, which is offered through a cohabitation or a marriage contract. And that kind of just defines, hey, like, this property is not a matrimonial home.
Okay. So there's two different types of agreements between me and my kid, and then an agreement between my kid and their partner.
Yeah. And again, it's really just the intention between the parties, right? It's kind of like a will. So you're protecting, when you get a will, you're protecting your assets when they're being passed to your children, because you have to pay the estate administration tax, and any tax is payable beyond $35,000, right? So that's easily any client base who have one property or additional properties, right? So a will is to protect in case something happens to you. A domestic contract, a cohabitation agreement, or a marriage contract is to protect your children if they ever enter into a relationship and they're sharing any of those properties you've worked so hard to build.
How does a lawyer teach a client to bring up this conversation? Because it's kind of awkward, right? It's like a life insurance conversation. Hey, right? Like how do you bring up that conversation?
Yeah, that's an excellent question. It's really just about sitting down with the other party and trying to amicably discuss, like, hey, I don't know, my mom or my dad, they worked really hard to pass me down this condo or whatever it is. I want to make sure, you want to enter into a happy marriage or whatever it is. And most of the time it is an insightful conversation, and you find out, and I feel like it does help the marriage become healthier, or because they might also have wealth that's being passed down from their parents, right? And they want to exclude that as well when they're entering into a marriage. So it's really just about sitting down with your partner and talking about finances, right? We're being adults here. We're all, putting everything on the table. And it's really talking about your finances and expectations, and, not just one party using your condo or whatever to their benefit. And then all of a sudden, when the relationship goes sour, they're taking advantage of your profits or your assets. And really the conversation, if had beforehand, is always a lot easier when everything's happy-go-lucky,
right?
As before the relationship sours. Yeah.
Okay, so it's a conversation that I have with my kids, right? And saying that this is what we're going to be doing. We're going to be talking to a family lawyer, and then getting, having this agreement in place.
Yeah, you can definitely push your daughter or your son in the direction like, hey, I understand you've been seeing so and so for a period of time. I would recommend speaking with a family law lawyer.
Okay. And then you said that it costs a couple of $1,000s to make sure that your asset is protected. Now, the scenario we're talking about is where a kid is living in like my property, right? And then my kids are living in there with their partner or whatever, right? What happens if they don't live in any of my properties? Am I protected? Am I okay?
That's when there's less of a concern. But in a lot of my client files, or in just my personal experience working with clients, there's generally an estate that's worth $2 to $4 million. There's multiple properties. The young couple, they run businesses together. They're living in X, Y, and Z in like Miami. There's a condo there. There's a condo there here. And then, all of a sudden the relationship goes sour, and it's just a messy fight for all of the properties. So really, again, like, and sometimes there's commercial properties, right? And they ran a joint business together. So if you have any sort of contract in writing saying whose is, whose, it's a lot easier, and you don't have to fight over it and spend tens of thousands of dollars, if not hundreds of thousands, protecting your assets that you've worked so hard to build.
Right. So spend a little money now to protect your wealth. Okay, beautiful. Anything else that you want to tell our listeners today, Derrick?
Speaking to a family law lawyer, or just any lawyer in general, estates, and just, opening your mind and broadening your horizon just to see what kind of options are out there. And also just be mindful of, when you enter into a relationship, if you have a joint account or you're commingling funds, I would just advise you to be wary and perhaps talk to a legal professional.
When you're commingling funds.
So whenever you're running a joint venture or a joint business together, or you guys have a joint car together, right? So if anytime there's any sort of joint properties, just be very careful.
Okay. All right. Beautiful. I really, really appreciate this, Derrick and Ben, for, bringing us insight on how to, be on the defense, right? J.O.M.P is all about the offense, and we're talking about defense, how to protect the wealth and the assets that we have today. For my listeners here, guys, the strategy of building wealth outside your 9-to-5 is through the J.O.M.P program. The J.O.M.P program is all about owning just one more property. And that's an area that I, as a mortgage agent, specialize in. To learn more, go to my website at sylviaho.ca and let's chat. It takes 15 minutes to know whether you can pick up another property and increase that net worth and build wealth. So thank you very much, everyone, for listening. Thank you very much, Ben. Thanks, Derrick.
We just heard from Ben and Derrick and how to protect our assets that we worked so hard to get in the J.O.M.P program. You know what? The number one thing that the wealthy people do is they have wills in place. They have life insurance in place. They have prenups, and they have cohabitation agreements. They do that right away. It's normal for them because that's what they've been taught. But as the middle class individuals, that we were not taught that stuff. That wasn't what we did automatically. So when it comes to protecting our assets, we need to rewire our heads and rewire the way we think about wealth and think how the wealthy do it and just really, really copy them. Hey friends, thanks so much for listening to the Sylvia Ho Mortgage Podcast. We'll catch you on the next episode. You want to learn more about the J.O.M.P program? Please connect with me at sylviaho.ca. Love to hear from you. All it takes is 15 minutes for us to chat to see if this will work for you. Thanks, guys.